today. 9 months into the pandemic, 5 months since our last webinar with the same panelists. And certainly it's an ever-changing environment that we're going through, and definitely excited to hear the panel's update on the outlook on the market. I'll start with the global economy, move down to the Canadian economy, and then into the housing market. Now we're going to give you just a couple of minutes to get settled, get everyone in, and we're going to start off with a quick poll for the audience, which we'll do maybe three through the process. So just to get you set up and going on that. So we'll get that first poll up so that you can see it, answer it, and then we'll share the results. Previously in May, just to give you an idea of what we had before, about 70% of people said they were doing well, 57% at okay, 13% at walk in the park. So we'll see what the differences are here. 30% of people thought that it was a very challenging environment. And I think that part of that is there were so many unknowns going into our last webinar and the information that's there. So quickly, just giving you an idea, the last time we were there was, again, so many unknowns, the impact of the pandemic to our marketplace, to the whole economy, to the whole Canadian market. And we've lived through that, and it's really been somewhat of a challenging time. Certainly at the time, there were lots of forecasts as to what would happen in the economy, the housing market, both the sales volumes and values. Some of those estimations were crashing markets. What we did find out was that it didn't crash, certainly slowed down, and then came roaring back in the last part of the last few months. Certainly it feels like we're into a spring market, just offset into the fall. And what we're going from now is where we have a number of more information points, more information and certainty maybe around what's going on with interest rates and so on. But there's still lots of unknowns with the second wave coming through, how that's going to impact, what kind of closures and things we're going to have. So the purpose of today's event is really to bring together everyone, some insightful discussions on the economy itself, generally, more specifically around the housing markets and market trends, and some of the expectations for the future. So let's get down to it. And I could certainly go through a couple of housekeeping points first. We are recording this webinar, and we will provide you a link afterwards. The audience is on mute, but we do have the Q&A part of the technology working. So we'll keep questions going there, and we'll try and answer as many as we can. We have about 35 to 40 minutes or so of the moderator questions, 10 minutes at the end for audience questions. It will be interactive, and we'll do some polling along the way. At the end, we'll put together a quick questionnaire to get some feedback on today's session. But let's get down to the real reason that we're here, the Economic Power Panel. You certainly know these gentlemen well, so I want to spend more time listening to them and less time introducing them. But we have Benjamin Tall from CIBC, Derek Brolton from TD, Robert Hogue from RBC. All three gentlemen incredibly well known and listened to by the marketplace, and we're excited to hear what they have to say. So let's kick it off, I guess, with Benjamin, first of all, on the global GDP and global economy. And what if you could give us an idea what your base case or what your future thoughts on the economy globally would be?
Yes, I think that when you talk about the global economy, you talk about where we are when it comes to the virus, and you basically have three models, if you wish. One is the continuation of the first wave or well into the second wave. That will be the US and most of emerging markets. The second model is Canada and most of Europe, which is the beginning of the second wave. And the third model, which is the most interesting one, places like Japan or Australia, where you see a situation in which they are at the end of the second wave. So you can get a sense of what they did in order to bring the virus down without shutting down the economy. And we see that really, if you look at the mobility index in places like Japan, Australia, they did not shut down the economy, and they were able to bring the virus down. So I think that's more or less where we are going. You will see Europe, you will see Canada to an extent even the US, not shutting down the economy, not going back to March or April, and still being able to slow down the virus in the second wave. I think that clearly what's happening globally is a factor of what we are going to see early next year. I believe that in places like Canada, you will see rapid testing in January, February. That's what people are telling me in the field. There is no reason to doubt it. Second, there will be some sort of antiviral, and the third, and by the second half of the year, we are going to have some sort of a vaccine. So for the first time, we will not be totally helpless against this virus. However, the duration of this crisis means that this is not an event. This is a condition, and we will have to learn to live with this condition. So overall, I expect the next 6 months, especially in North America, to not be great. I think the honeymoon of the summer is over, and you will see overall activity slowing down. And in North America, I see a situation in which GDP will not reach pre-recession level before 2022. So that's more or less where we are.
That's great. Thank you very much for that, Benjamin. And Derek or Robert, anything to add on the global economy view?
I mean, not really. I think Benny captured it well. I think really the easy returns have been realized in terms of a quicker recovery thus far than we had expected. But now the tough grind begins, and agree with them that it's going to take an extended period to get back home. We often refer getting back more to normal levels of activity, probably at least into 2022. In some cases, like the unemployment rate, we don't even have converging on pre-virus levels until 3-4 years out from now. So it's going to take a while, and I think most forecasters are on that same page.
Okay, and Robert. Oh, there we go.
Okay, no, we agree with that kind of general pattern and picture. We are definitely, at the mercy of the pandemic. I mean, at this point, our view is that it's more about the policies and the restrictions put in place that are the main focus as far as the economic performance. And as Derek mentioned, I mean, the next stages will be much more difficult to achieve the kind of growth that we saw in the initial phase of the recovery. So us too, we have return at this point in our main scenario to pre-pandemic levels in probably first half of 2022, but that too kind of remains quite uncertain.
Okay, let me just give you a quick summary of the first poll that we did. So much smaller group at Walk in the Park this time, only 3% of people thinking this is a walk in the park. Certainly extending longer than a lot of people thought, and now the second wave coming. 50% of people at okay, 30% at tough, and 17% challenging. I certainly think the length of this and some of the unknowns around this second or third wave coming through is starting to impact people's view, and maybe that's somewhat reflective of where the economy is going. When we get down to now the Canadian economy, we'll get started, and we're just going to do a quick audience poll on the shape of the recovery around the Canadian marketplace. So we're going to flick that up there. There's some shapes that are not there. We talked a little bit about that offline, whether it's a W or an extended W or even a K type of recovery. So other types of economic views on the marketplace. So we'll give you just a minute or two to pick your expected recovery shape, and we'll give you some results there. A little bit of background on our last webinar, about 60% of people thought it would be a W. So a relatively quick comeback, another valley, and then coming back after that. And then 30% were either in the U or the L-shaped recoveries. I think that certainly, I think the first part we hit a bit of a V shape. Whether we go back down is a great question. Okay, so we'll close off the poll there. We'll get you the results in just a little minute, in a couple of minutes. But let's turn back to our economists. A couple lightning round questions. So we'll do it in alphabetical order. So Benjamin, then Derek, and then Robert. The first one is about the shape of the Canadian economy recovery from your perspective. So let's get kicked off with Benjamin.
Yes, I think that you have a V there and you have an L there, and we got both basically. 2/3 of the economy in a V-shaped recovery, and one L is basically stuck, and one third is stuck in an L-shaped recovery, and that's something that I think will not change. If the L economy was unable to recover during the happy days of the summer, surely they will not be able to recover during the darker days of winter. And going back to the level of activity, even what we have seen in the 2/3, it's not really a pure V-shaped recovery in a sense that we are still, for the economy as a whole, the combination of the V and the L means that we are down basically 4.5% relative to where we were before the crisis. To put it in perspective, in the 2008 recession, from peak to bottom, the economy was down by 4.5%. Now, after the recovery, we are down by 4.7%. So in other words, we are recovering, I repeat, recovering to the darkest day of the mother of all recession. That's a recessionary recovery that we were talking about.
Right, okay. And Derek.
Yeah, I have to say, when I look at my charts now, and you look at GDP employment, and that's one of the surprising things, I think, if we saw the employment report out last week, that Canada's job recovery is proceeding a lot quicker than the US, and that's been one of the bigger surprises based on comparable data. But I think more of my charts are looking like a square root sign, where you take the early stages of that V and then you add kind of a flattish line going forward. And we know in reality it's not going to be that smooth, but I think in general we kind of try and forecast through some of the ups and downs. It looks more like a square root sign.
Excellent. Okay, and Robert.
Well, yeah, square roots. Our thoughts initially were it's going to look more like a check mark, and maybe a square roots gets somewhere between the two, perhaps. And the next stages, as I indicated earlier, is probably going to be much lower grind. Although it's as you just mentioned too, I mean it's directional as opposed to really prescriptive, as opposed in the for the level of activity going forward. It's more in terms of trends. We have to expect there's going to be some volatility around that trend from quarter to quarter. But at this point, there's no real sense for us to deviate from our earlier thoughts of a check mark.
Okay, very good. The next question, just in terms of the expecting, and I think the key word here is full recovery. There's some expectation that maybe it's not out until 2022. Is that the full recovery? Is that just the initiation of the recovery? And we'll start off with Benjamin again on that. Oh, we have you on mute. We should. There we go.
Yeah, I think that from a GDP perspective, yes, 2022 is a reasonable guess at this point. From an employment perspective, I think it will be more than that. But I think that much more important is the nature of the economy that we are recovering, to what extent this economy will look different. And of course, it will be very different. So the level of activity will not be the way to measure it, but the composition of the economy. I suggest that a lot of the trends that we have seen before are being accelerated. E-commerce is one of them. I think that the gig economy will be much larger following this crisis. I think that the tax level will be higher because somebody will have to pay and balance the budget. So I think that the economy will look different, but it will be, in a sense, just acceleration of what we have seen before. So I think the focus should be not only on the level of activity, the number of jobs, but the type of jobs, the composition of employment. I think that's where the focus should be.
Okay, great. Derek.
Yeah, I agree wholeheartedly with those comments. I think we got a bit confused when you hear that term full recovery, but I think we know that when we emerge from this, we are going to look a little different. And for some sectors, that so-called K-shape that Benny was describing, that's going to apply, albeit, and we'll get into this maybe a bit later on the housing side, that I tend to resist this notion that straight lining forecasts. I've done that too much in my career, where you straight line, and it turns out there's a bit more resilience to some of these general trends in terms of sectors. 9/11, we thought nobody would get on a plane again, and they did. So just be a bit careful assuming these trends prevail.
Okay. And Robert?
Yeah, there's no disagreement here. But keeping in mind that when we say full recovery is back to pre-COVID levels sometime in our view, the first half of 2022, but it's not where we would have been otherwise, had it not been for COVID-19. So there is some loss, effectively some permanent losses there. And the degree of those losses, we'll find out more and more as we move forward, and how many businesses will have gone out of business, and certainly some sectors, their outlook, think airlines, for example, are probably look pretty dismal for a period of time, but eventually it'll recover, as some of them will recover. Again, I think when we say full recovery, we're talking to pre-recession levels, and not where we would have been had it not been for COVID-19.
Right. Good point to keep in mind, just what we actually recover to. Just some feedback on that second poll that we had. We had about 47% of people picking W-shaped. Certainly that next phase, what this next second coming of the pandemic, what that does to the marketplace, and then coming back. 29% of people, 2% of people thinking V-shaped, so that we're up and good. I think that we did not have that square root option or the K-type option there, but 24% of people thought unknown or other. In the case of, well, it's not one of those simple options, and we had about 19% at U-shaped, so taking a lot longer at the bottom, coming back maybe longer term. So interesting results there. Let's go on to the labor market now more specifically, and the pain in the market's definitely been uneven, and I think Benjamin, you had recently done a report on that, and maybe we could start with you just explaining more about this unevenness in the labor market.
Yes, of course. I think that if you look at the nature of the job loss since the beginning of the crisis, it's the most asymmetrical job market trajectory in history, I believe. As we all know, about 80% of the decline was among low-wage occupations. Any other recession, you get about 50, 55%. So it's really very abnormal here in this sense. So the quality of employment is a major factor here. Same goes if you look at by education. Although clearly less educated people lost more jobs, even within the education segment, you have seen the share of job loss higher than their share in the labor market in general, which means that the mismatch in the labor market is really impacting also more educated people. That's something that we have seen clearly. The role of women in the market is very, very important. It's not in terms of more women losing jobs, but in terms of hours of work reduction, more among women, and the daycare aspect is definitely a factor there. We have seen something very interesting in the labor market, and I will just highlight that. To me, it's a reflection of the fact, to an extent, that some government money is going to where it shouldn't be going. And again, that's not a criticism, because government was trying to help as much as they can. In the early part of the crisis, they needed to do so. But look at this, the number of unemployed people that just a month before were not in the labor market at all, namely they were not even looking for a job, has risen by 500,000, which was at one point half of the increase in unemployment. This is people that were not in the labor force before they became unemployed. Okay, so they were not, lost their job. They simply were not there. 66% of them, 2/3, are students. So all of a sudden, you have a situation in which many students are now looking for employment, and they are unemployed. And we know that clearly this number should be rising because of the nature of the crisis, but I'm asking myself, to what extent the availability of CERB was a factor triggering this sudden interest in the labor market. The point that I'm making is that the system must distinguish between a 17-year-old student that is not happy with his or her allowances and is now declaring himself or herself unemployed, and a 45-year-old parent of two that is collecting CERB. We must distinguish between the two.
Oh, interesting dynamic in terms of looking further into certainly that unemployment group and the breakdown of that. We certainly know that the economic movement momentum going forward is going to be tested in addition to the labor market by several other factors. Derek, can you give us some more expansion on that?
Yeah, I mean, there's no shortage of potential landmines as we move into through the final quarter this year into early next year. The end of the mortgage deferral period. Obviously, we've talked about COVID, and I agree with Benny that hopefully we'll get to a vaccine by midway through next year, and hopefully we'll be able to contain the second wave. But there's uncertainty there, and so I'm concerned about that. Considered about some of the pressures on households. Peak emergency benefits. We're moving into a new phase where government's extending many of them, but we probably won't see the same money flow out the door quite to the same extent. I worry about financial markets. Patterns have been so smooth there through government asset purchases, supports from governments, but we've got a US election coming up. There could be some real turbulence coming down the road. So I'd be surprised if we don't go through some significant bumps over the next few months, given where current valuations are. So I think that truly will test the recovery. I think the big thing, though, is just the time. It had been that view right from the start, and held among many central bankers. The longer COVID goes on, the more businesses and households will face strains, will have to hold on, and clearly some won't get to the other side. We're already seeing that. How many? The jury's out, but at the very least, it's going to lead to more delinquencies going forward, more bankruptcies, more scarring in the economy. And to what extent? I think we're trying to build it into our baseline of a gradual recovery from here, but certainly had a lot of question marks around that. And to the audience poll, certainly wouldn't rule out a W. I know we don't build in a second recession, but if we get sort of that perfect storm of factors, you could get tipped into one.
Right. Okay, let's move on to the provincial outlook. And Robert, maybe you could give us your feelings on the provincial breakdown of who's going to be the quickest to recover and who's going to be most challenged in that recovery.
Yeah, well, let's just state up front that this recession is like the biggest one that every province. I mean, there's no exceptions here. There's no province that managed to escape it. This is going to be, if not the worst 1 year decline in for every provinces, it is going to be very close to the worst. So let's just be very clear up front that this is a horrible shock across the board from coast to coast. Now, what we've seen in terms of how the differentiation across Canada, and it largely reflects how COVID has hit various regions. And we've seen Manitoba, for example, that in our view is going to contract. Yes, but probably less than all other provinces. We've seen Atlantic Canada as well, where the contraction has been less. Again, reflecting that the fact that they have not been up until now, at least, as adversely affected from a health perspective. And at the other end of the spectrum, you have the oil-producing provinces, Alberta specifically, but also in Newfoundland and Labrador, where it's been a double whammy of COVID plus plummeting oil prices earlier on. That's really combining a huge punch to those economies. So. And then, in between, you have Ontario, Quebec, where the health situation was really quite dire in the spring, and things are now going through a second wave. Now, probably going to see a few challenges again. But how things kind of set up for the year ahead is that the hole is not equally deep across Canada. You've got some provinces. again, like Manitoba, that's going to spring back next year. But if you simply measure by the percentage change from 2021 relative to 2020, it might not be quite as large as even Alberta, because Alberta's hole has been so deep. So there's going to be some base effect there. The good news is, in our view, all provinces are going to grow in 2021 relative to 2020. But again, we don't see any of the provinces being out of the woods entirely by next year. Maybe Manitoba might be the closest one to be back to 2019 levels on an annual basis. But again, this is across the board. We're talking probably much more likely to be a 2022 story rather than a 2021 story. And so again, that's assuming that the health situation gets under control. Whether it's everybody gets vaccinated by the end of next year or not, we'll see. We hope that our medical experts are going to come through, but at this point, it's only some assumptions that we can make.
Oh, very good. Let's move on more specifically to the housing market, and we're going to launch it just quickly with a audience poll again. Your expectations of where you think the housing market's going to go, both sales volume and prices, I guess. So we'll give you a minute or so to answer that. Most of those numbers tend to be downward facing. Last time, we thought about 40% of the audience thought it would fall by 6 to 10%. Another quarter expecting less than 5% fall. As it turns out, I think certainly in terms of values, we haven't seen any drop, and in some cases continued increase. Sales volume, well, it went off certainly at the beginning of the pandemic, came roaring back in the months of June, July, August, and September. So we'll give you just another few seconds to answer that, and then we'll put that up there in just a minute. But the shape of the housing recovery, let's maybe start with Benjamin, looking backwards first. What do you think happened in terms of that V-shaped recovery that we might have seen through July, August, and September this year? And what's going on there?
Yes, I think it's very interesting. Was it a surprise? Of course, the speed was a surprise. The trajectory was not a surprise. We knew that there was a significant pent-up demand. Back in our previous conversation, I think that we shared the results of a survey that we did, and 25% of Canadians, actually homeowners, told us that they're going actually to invest in the housing market. That was in April, during the craziness. So the question is why? Now, is it interest rates? Well, obviously, interest rates are much lower than they used to be. However, back then, in 2008 or any other recession, we didn't have the stress test. So relative to the other recessions, our qualification rates today for variable and fixed are at about 479, I believe, are higher than they were in 2008. Although 2008, the housing market was lower than it is now, clearly in 1991. So we are seeing a situation, this is the most housing-friendly recession ever. And it's not just because of interest rates. And the question is why? To me, the answer is really the composition of the labor market. Again, as I suggested earlier, 80% were low-paying jobs in terms of job loss. So a huge segment of households did not feel the pain, economically speaking. Their income did not go down. In fact, it went up. And the house, the interest rates are relatively low. That's the opportunity they were waiting for so many years. And I think that's one of the reasons. We have to remember that this is also about the composition. If you look at prices, when people answer this survey, we have to distinguish between just price inflation and the composition of labor market activity that is impacting prices. I estimate that about 50% of home price inflation today is because of the composition factor, namely people moving to larger units, detached, and therefore more activity in the more expensive segment of the market. So that's something that we have to take into account.
That's interesting. That may be a new phrase, housing-friendly recession. So something to look out for there. Just quickly, some of the results from that audience survey. We had about 53% thought that house prices fall less than 5%, 25% the 6 to 10, and then smattering 10 to 15 at 10%, over 15, 3%, 9% unsure. So interesting results there in terms of what people feel about that market. That has come back so far. Derek, is this a sustainable level that we can deal with for resales? And where do you expect that to go?
$1 million question. Yeah, I think, and Benny touched on some of the unusualness of the current situation, where the recession has been most prominent in the type of household tend to be more renters, and that's all true. I still don't think that such a large disconnect between sort of the broad economy and housing markets can continue forever. And I guess for us, and I think we're not alone, certainly that spot, I think it's guessing that the timing of a change. And my guess is it begins to happen by the end of this year. You start to see sales moderate, no matter how you cut it. Pent-up demand has been a very supportive factor. When the markets were effectively closed through much of the second quarter, we saw the huge leap up in the third quarter to about 165,000 units nationally. Some of that pent-up demand's been sated. I think just the affordability constraints, the race for space, at some point that house in the suburbs is going to price some people out of the market. So I think these factors are going to start very soon to show up in the sales data. We expect, by kind of the end of the first into the second quarter next year, down to around the 130,000 level of sales. So a significant adjustment, but still not really low. Prices coming back 7%. So we're in that 25% camp of the group watching, between 5 and 10. That's our guess, but that probably won't happen until sort of through the first half of next year, and kind of a peak to trough basis. In terms of segments, one would think reasonably that there's so much momentum in favor of these ground-based dwellings that we're not going to see it just abruptly end. One of the factors we look at, metrics, would be the ratio of condo prices to single attached prices. It still does favor the condo segment, so there is some wealth there that can be gained through selling and purchasing. So I do see some further room to run just based on that. Do I worry about the condo segment? I certainly worry about some of the micro units and big downtown cores. Clearly it's more than just this notion I want to get out of these extremely dense areas in the very near term to a bit more space. You've got a lot of these investor held units, and the economics behind them are just not as favorable. We're not seeing capitulation, but we do see more listings. So I would imagine the condo, particularly the smaller units, very regional, underperforming that 7%, seeing a bigger drop in the near term. And I guess very lastly, the big debate is this a trend that we're going to see continue over the next few years? And again, I think affordability kind of a constraint. I do think if a vaccine can come in place, that would be a real confidence booster for living downtown and investing downtown again. So I wouldn't write off some of the resilience of the condo segment over the medium term.
Okay. And this may be a bit of a loaded question. So you think around a 7% drop in values, that's sort of in line with the Moody's RPS forecast. But CMHC's come out and sort of reaffirmed their view of somewhere between a 9 and 18% of drop in value. How do you see that? Is that them looking at the conservative side, or what are your thoughts on that?
Well, it's deeper than ours. I don't think it's off the charts. I mean, we're at 7, and it wouldn't take a lot to get into their range. 18 is getting to be a pretty hefty, and I think, again, that's at the tail end of their range, which would suggest a worse economic outcome. You're getting into a W-shaped economic scenario in that case. And, again, the big wild card here is the condo segment. How weak will the rental market get? How will that affect investors? How much of this will end up in the listings market, as well as mortgage deferral? How many individuals that have to make payments again decide they're going to list their houses? So a lot of questions, but I'm comfortable with our view of kind of that high single-digit decline.
Okay. Very good. Robert, maybe we can get into some specific markets, the Toronto, Vancouver, Montreal, and Calgary marketplaces, and what you're seeing or expecting in terms of activity, house prices, for really different markets, I would say.
Yeah, okay, well, but let me just start with answering the previous question, our view on prices, because our thinking, at least in the aggregate, has kind of evolved over the last, I would say, couple months. Now, we don't see a price decline overall next year. We do see some weakness, and this is how I'm going to segue into your question, into some in some of the housing segments. Condos, as Derek indicated, in certain downtown locations, for example, we see, there's a lot of supply coming to market right now, and there's much fewer buyers at this point. So we do see some potential weakness and potential some price declines in those market segments. And when you aggregate it all up, it's hard at this point for me to imagine that there's going to be some material price declines in overall in Canada, and even I would argue in those major centers like Toronto, Montreal, Vancouver. This real drive on the single detached homes or low rise in general towards the suburbs as well. There's, I think, and the starting point now is being so tight. I just don't see prices declining in that kind of context. We do have demand cooling, and quite probably in potentially short order, but from record high levels. So we're going to see some adjustment there, and the supply will adjust to a certain extent. As well. So we're at this point, we see prices in Vancouver, Toronto, Montreal, Ottawa in particular is still moving forward in the very near term, even potentially accelerating further. On the condo side, some weakness, and I think it might well translate into a drop in prices, possibly. Well, maybe in Toronto we might see that by the end of this year, but in some other markets it might be delayed into some kind of next year. And the other thing to mention is there's a lot of activity now moving outside of those large urban areas, and maybe that's something I think we're going to discuss a little bit later. But that's something that's quite remarkable. Those markets that are a couple hours away from those major urban cores are red hot right now. They are firing on all cylinders, and there's tremendous pressure on their housing stocks. And in fact, there are some of those markets are where prices are, for example, in Ontario, where prices are rising the fastest right now. And there might be, and that trend might have a little bit more leg to it at this point. We might, because of let's call them semi-permanent changes that that COVID is bringing to the workplace. For example, a lot more people are working from home. We're just going through this massive experiment of working from home. That for many organizations, it proved to be successful. So I see that trend continuing and maintaining upward pressure on prices in those, let's call them smaller markets.
That's excellent. Can you just quickly comment? I know you referenced it, what's going on in the Ottawa marketplace. The activity that's going on there, it's not so much outside, or I guess it could be outside Ottawa City, but that market seems to be sort of continuing strength.
Oh, absolutely. I mean, it was the hottest market, and I would argue continues to be the hottest market in Canada for the last couple of years. Montreal was gradually catching up. There might be some of our markets, like in Halifax out east, that are pretty robust at this point. But there was sheer demand. I suspect part of it was Ottawa was relatively attractive from an affordability perspective compared to Toronto. I'm not quite sure how mobile people are going from Toronto to Ottawa, but I'm thinking if you are an immigrant, for example, thinking of buying relatively soon, Ottawa looked better than Toronto from the prospects of owning at some point. So I suspect that was one of the factors that drove a very strong demand in Ottawa over the last few years.
Okay, great. Let's move on to actually the deferral programs, and we're going to get Benjamin to comment on this. But recently, we had hosted a webinar with the executives from CMHC, Canada Guarantee, and Sagen, what used to be Genworth, their new name. That's great. And they told us about the level of the deferrals actually peaked somewhere in the month of May, around 18%. By June, it was 12 to 13%. So people had come off the deferral program. We hear that it's continuing to go down over the last few months. And they sort of described it as a hill rather than a cliff. Benjamin, could you give us your thoughts on that?
Yes. Now, before we get into it, one more aspect of the price appreciation, especially in places like Toronto and Vancouver, because I think it's important to put things in perspective. I totally agree that the market will slow down with the economy in the next 6 months. You cannot totally detach the market, but within the market, clearly the condo market will underperform detach. We know that. But what I was interested in is to see to what extent home price inflation is rising faster or slower by price level. Namely, to what extent inflation is rising faster in the cheaper properties and vice versa. And we look at Toronto and Vancouver, and what you find in Toronto for condos and detached. And what you find in Toronto, for example, is that in the condo space, the price inflation is uniform. Basically, regardless how cheap or expensive the unit is, it's rising more or less at the same rate. What's interesting is that at the detached segment of the market, the more expensive the house is, the faster its price is rising, which is a nightmare for mover-uppers, if you wish. But it also means that you will reach very soon a resistance level in terms of price, and that will slow you down. That's Toronto. Vancouver, the opposite is the case. In Vancouver, the more expensive the unit is in the condo space and in the detached segment of the market, the lower or the slower the price appreciation is. A negative correlation, and to an extent, this is a reflection of reduced foreign investment in the condo space and in the detached segment of the market, which is the more expensive segment. That's an interesting window that might give us a sense of what's happening or what will be coming over the next 6 months. I totally agree. The market as a whole will slow down. I think that the first casualty will be the condo space as opposed to the detached. Going to the deferral very, very quickly, I totally agree. I'm not losing sleep over it. I don't think it's a big deal. I think that we did a lot of work trying to quantify the vulnerability. So it was 16%, it went down to about 12, 11% during the last few weeks of the program. About 80% of them are dual income. So you have an insurance. The loan to value ratio is about 50%. Then we say, okay, let's take a look at other factors. Looking at the credit score is not really helpful here, because in fact, if you defer, but you are current, your credit score is going up, because if you're delinquent and you just make one payment and you start deferring, you're actually artificially raising your score. So I will not look at score. I will look at how many of them took a SERB, for example. How many of them have seen their deposit account rising during this process, namely they were parking the money and they didn't need it for consumption. How many of them use the money to optimize debt? We did all this exercise, and you come up with a solution or with a picture in which, yes, delinquency rates will be rising, but this is not a cliff. This is not a smoke by any stretch of the imagination. And if you look at the amount of money banks put aside to count for that, more than enough. So I'm not losing sleep over that.
Yeah, the one thing I would add too to that, good response, Benny, is the government supports. And we had been worried about an income cliff as governments were to turn off their emergency supports. But if you read the speech from the throne last week, realize that there isn't going to be any stopping of supports anytime soon. We may have seen peak support, but it's going to be a very gradual pullback. The finance minister almost sounded Draghi-like, and the prime minister, and doing whatever it will take to support the recovery. So I think that's another key factor that really mitigates the risk in this space.
Okay. Thank you for that. Let's move on to just some changes, and I think, Robert, you referenced this earlier, changes to the housing demand, the types of homes, what property types and location. Can you give us some information or your thoughts on that?
Well, yeah, I think there's a lot of current homeowners over the last few months that have reconsidered their housing needs, and that's all because of COVID. Now they can work from home. Now they don't need to live that close to downtown, and they don't need to commute either at all or as much. And for many, it might just become a permanent, feature. And that, I think, is prompting a lot of that moving towards the exurbs, and as far as cottage country that you've seen, a lot of city people just moving out. I was looking at some numbers for Georgian Bay, just north of Toronto, and that's a super hot market right now. And I think, even though once we'll get all vaccinated, and we'll all know, we'll be looking back at COVID as this horrible episode in our history, but that's it's going to be, we'll be talking about it in the past tense. I think there's still going to be a certain a high proportion of people who will work remotely, and this is altering those housing dynamics. At some point, it'll reach a new equilibrium, but I at least in my mind, we're a few years away from this still. I think we're still going to be that. There's still going to be a certain churn in the housing market that would not have occurred had it not been COVID-19. So we're going to see some both demand and supply being created by COVID-19 for a period of time still.
Okay, very good. That really is the end of our set questions, but we do have some questions that we've picked up from the audience. And one segment of the market that we hadn't talked about, we talked about resales, but on new builds. So for any of you, where do you think that new home built product is going in terms of volume and development?
Well, I will start. Clearly, we are seeing mismatch in the market now, where the starts in the multi-residential aspect of the market is, the number is rising way too strongly, in my opinion. So we'll see some excess supply there. We clearly see more supply coming to the rental market, and the rental market is slowing down. So there is a short-term mismatch. Clearly, you will see a situation in which builders will still adjusting. So if I look at the next 2 years, I suspect that housing starts will slow down, and the composition will be shifting towards where the demand is and the lack of supply is, which is low rise. However, the ability to really raise housing starts significantly vis-a-vis the low rise is limited due to obvious reasons, and therefore I suggest that housing starts will not be way much more than, let's say, 200K, and the composition will change.
Yeah, I agree with that. What in terms of actual starts, though, I think the timing is going to be complicated, and that's something that really puzzled me in the worst part of the COVID-19, where we thought the sky was falling, and yet housing starts were just ripping in Canada. And only 1 month in Quebec, because they shut down the industry, we saw starts going down to zero, but elsewhere it was barely a blip. And in large part, I mean, on the multi side of the market, it reflects sales that were done pre-construction a year or two or even more. And so even though I agree with Benny here about this mismatch, I still now strongly suspect more that there might be momentum that will carry a little bit longer than I would have thought just a few months ago. So it might carry us into potentially good parts of 2021. Now, officially, my housing start forecast for 2021 is coming down quite a bit. But I've been so wrong over the last the last few months that I'm starting to acknowledge that there's probably still more in the pre-construction stage that will flow through starts for potentially the first half of next year and even longer.
Yeah, one factor that's not as positive is the demographic side, and we have seen population growth slow a lot this year. Now that said, we had earlier on in the early part of the pandemic almost had immigration heading to zero, just given closed borders and the like. It's held up a bit better than that, but no matter how you count it, it's still the government's going to be well short of its immigration targets this year. The question is, what is the prospect for a rebound in 2021 into 2022? And we just have growth coming back more to a normal rate. We don't have it going back to its pre-recession peak of, I think it was about 1.5% and per year. We'd have it returning kind of to 1% per year. So maybe we're too negative, but when we talk about slowing housing demand and slowing starts, clearly part of that formula is a weaker demographic profile.
If I may, let's talk about demographics for a second, because I think it's important and it's clearly a factor that we have to talk about. And yes, it is slowing down. The negative factor here is very clear. However, I think that there are some compensating forces that we should discuss. First of all, the number of new immigrants. We have to remember that at any point in time, about 30 to 35% of new immigrants are already in Canada. It's just a change of status. And that's why what the number is 150 or so. It's not because we opened the borders, but because of the fact that they were there already. So that's one thing. Second is that there are about 3.5 million Canadians living outside Canada. Most of them are in the US, but 400,000, according to our estimates, are in Hong Kong. We know what's happening in Hong Kong, and our estimate, although there are no official numbers, but if you look between the lines, is that we have already seen about 90,000 returning citizens coming from Hong Kong and the US, something that you cannot distinguish between them and tourists, according to the way we count it. But if you look at the trend, about 90,000. So that's 90,000 that are coming back and basically consuming real estate. Third, every year, 100,000 Canadians move to the US. Those are the brand renters. They're not moving anywhere. They're here. Those are 100,000 Canadians that stay home. They're not selling their houses, or they're looking for houses in Canada because they might be working for this New York company from their basement in Etobicoke. So there are some forces compensating for the lack of immigration and non-permanent residents. Not to say the demographic story is positive, it is negative, but it's maybe not as negative as perceived. And most of the impact, at least in the short term, of course, is on the rental market as opposed to the resale market.
Very interesting. Benjamin, you had mentioned earlier about the rental market, the multi-unit. Maybe you give us your thoughts on the rental market itself. Is this reduction in rents, is that more supply and maybe not as much demand, or same demand, just more supply? Like what are the factors going there, and what's that recovery look like?
Well, I think that it's clearly both. The fact that we have less new immigrants and clearly less non-permanent residents that are very heavy into the rental market, they are not there. So clearly demand is reduced, especially in the rental market. But then you have the supply issue. I believe that the condo space is, starting way too aggressively. There are too many of them. We have seen a significant increase in purpose-built for the first time. Really bad timing. But we see more supply coming there. And then we see the conversion of Airbnb from short-term to long-term rental. That's very significant. So you have many, many forces happening at the same time, more supply, less demand, and therefore the rental market, which has been on fire, as you know, until the crisis, is now softening, which is maybe a good thing. I think the vacancy rate is probably exaggerated on the upside. And the reason is that, and I speak to many developers and many landlords, and they basically say, you know what, we are not going to basically list the property in this market. We are going actually to invest in it, make it prettier, so we'll be able to actually ask for a higher rent when the market stabilizes. So some of them are vacant, but they are vacant by choice. So the headline numbers exaggerate the real vacancy rate, in my opinion.
Right. Any other comments on that before we wrap it up?
Well, I mean, just to reiterate that the demographic story, the immigration story, or the in-migration story is having first and foremost the impact on the rental market, and I guess obviously there will be a spillover on the condo market as well. But that's it might have, in terms of impact, it might have a little bit longer lasting impact on that rental market. But I agree with Ben here that it might, when you look at it from a longer term perspective, the fact that rent is becoming more affordable, it might not be a bad thing for the longer term, for future household formation. It'll allow more people, the younger Canadians, especially in those major urban areas, to go on their own.
All right, very good. So that will wrap us up there in terms of our questions. So Benjamin, Derek, and Robert, I want to thank you for both your time and your sharing your thoughts with us today. Thank you to the audience for tuning in and joining us, and some very perceptive questions there. As I noted before, we're going to do a quick survey at the end of this to get your feedback. We will share the recording out there. So if there's anything going on or any additional information, please feel free to connect with any of the RPS team for anything that we can help you on or any other information. We hope you and your families, again, and colleagues, stay safe. The back to the office move may be halted for a little while, but people are getting used to working from home and seemingly very productive. So thank you very much for your time, and we hope you have a great day.